So we are going to move on to our project finance discussion. And joining us for this, we have two experts in this field. First of all, I'm going to be talking with Adolfo Dindo Abueg, who's the co-head of Project Finance Asia Pacific at Korea Development Bank. And then, shortly after that, we'll be joined by Arno van Hukelum, who's the Global Head of Metals and Mining Industry Lending at ING, who is at the back. So, gentlemen, if you'd like to join me on the stage. Arno. And, yeah, there we go. I'm going to come and sit down and have a chat. I'm going to take a bit more relaxed format this time and have a seat for this discussion. Welcome. Thank you very much, Arno, for rushing over here. He's been a very busy morning, so it's great that he's arrived just in the nick of time. That's the MRT in Singapore. Efficiency for you. That's brilliant.
Definitely.
Yeah, we had a conference in London a couple of years ago, and a guy tried to make the conference by taxi, coming over from the West End to the city, and he was about an hour and a half late for the panel. So it's great that you use the MRT and you get there on time. Perfect. I think we'll start. I want to sort of talk about the availability of project finance, and also it'd be good to find out a little bit more about what you guys are doing and what you guys focus on. So maybe if we could start with Adolfo, tell us a little bit about Korea Development Bank and your approach and why you're looking at the mining space.
Okay, thanks, Leo. Maybe just a short intro on KDB, Korea Development Bank. This is 100% owned by the Korean government, so it has the same rating as Korea, which is AA. In Korea, definitely this is the #1 bank in terms of financing all the infrastructure projects, whether it's power, infrastructure, energy. Basically, we almost have a monopoly over there. Going outside of Korea, I think looking at the league tables, we're probably in the top 10, also in Asia Pacific. Just a short history on our office here in Singapore. We've put up our project finance desk here in Singapore in 2012. That was the first time we've put up an office outside of Korea. And that was the decision of the management to really build our non-Korean clients. So since then, we've been very active in Australia, Southeast Asia. We've done some projects in US and in Europe, Middle East. In 2015, we've put up a project finance desk in New York to look after Americas. And then 2016, we've put up an office in London to look after Europe, Middle East, and Africa. Sectors that we cover will be definitely power, LNG, oil and gas, the typical infrastructure projects, and of course, mining and metals. As you know, the Korean companies are big off-takers of metals, different kinds of metals, and that's why there is a big interest for us to really support this sector and try to provide financing. So here in Singapore, we've been very active in Australia. In Malaysia, we did a ferro-nickel, ferro-manganese smelter plant. So we are keen on looking and supporting this sector.
And what proportion of your project financings involve mining, metals and mining?
I think in Asia, predominantly it's still power, oil and gas, energy. Not too much in mining, but we're looking at opportunities. I would think for any mining projects, probably mostly in Australia. But in Australia, the big projects there would be the PPPs, the privatization. But in some cases, there will be some mining project also.
And are there any particular commodities, looking forward, are there any particular commodities that you focus on more or like the look of?
Not really. It depends on the opportunity. Of course, the metals that we'll be looking at are the ones that, where there's strong demand. They're good off-takers. So those will be the kind of projects that we'll be looking at.
And typically, you're looking at commodities which, there's demand in Korea for, and you're looking to sort of secure strategic supplies?
Definitely. If there's a Korean angle, Korean off-taker, that would be there's a strong interest from us. But it's not always the case that we would support only projects with Korean angle. We could also support projects even without any Korean interest at all. So it's a good project.
Right. So sometimes they're just a financial investment. You think that's a good investment?
Yeah, that's right. For example, the one that we did in Malaysia, the off-takers were all Japanese. And we were able to support that project.
Fantastic. Arno, bring you in. Tell us a little bit about the ING team here in Singapore and the sort of things you focus on in the metals and mining space.
Yeah, I think we run a global team of about 20 people just looking after the mining sector, which I guess is a bit different from your setup. For us, Asia Pacific definitely has a heavy Australia focus. I think that reflects two things, mainly that a lot of the issuance or a lot of opportunities out of Indonesia are thermal coal based, and as a bank we've decided to exit that sector. But we effectively look at the full gamut from gold, copper, all the way to lithium and the kind of more fringe metals. There's definitely been a very good run of activity. At the moment I think it's a bit more quiet. We have a lot of projects that I think they are looking for financing, but the funding package isn't fully completed yet. So I think that's the kind of lay of the land. I think there's a lot of kind of corporate issuance activity at the moment, with the Rio selling down Kestrel. So I think that's keeping a lot of the banks busy. In terms of pure project finance issuance out of Australia, there is a few really junior kind of small end gold kind of developments. And then I think there's the other, which I would call more complicated things like clean tech, like a few of the Sheffields and the Pilbara kind of related issuances, which I think are a bit more unconventional and where I think banks struggle to get their head around it.
What's stopping them going into those more complicated projects?
I think a history of, just to kind of zoom out a little bit, I think over the last 10 or so years, I think the bank has probably financed in excess of 100 project financings for the mining sector. And out of those 100, I think 10 or 15 perhaps delivered on time and on budget and worked as intended. And the other 85 were, ranging from need some hand-holding to severe efforts to get everything lined up. So I think a lot of experience, firstly, in terms of what is more complicated than others. I think what we've seen is that less conventional metallurgical techniques and less and commodities with a more difficult end market are fundamentally more challenging to finance for a variety of reasons. But in essence, it boils down to typically that these markets are very small, therefore equity issuance is problematic. The chance that, if there's a difficulty with your project, that you'll have equity available to subscribe for additional equity when it's required is more difficult. So you box yourself in a bit.
Absolutely. But is that changing as there, you've got a lot of the analyst companies now looking at sort of providing more transparency on prices for some of these new commodities. People are getting more used to the technologies involved in the processing. Is that
well, I think we're probably, I think lithium is probably the first one to change. I think for a lot of the other ones, I think it's more problematic. And you see then effectively kind of two mindsets of juniors or junior mining companies that want to get their project off the ground. The kind of the one business model is the kind of conventional model, which I still think makes sense, but I understand the reluctance on the side of the juniors to do it. And that's the kind of full-fledged project financing route where you mitigate risk, where you look at the EPC contracts, you source strategic long-term offtake agreements, sometimes with kind of floor prices if you have not a fully commoditized solution, and you raise senior debt financing on that basis. And then the other extreme is effectively the issuance of stream financing or high-yield bonds, not too dissimilar to what Nemaska Lithium did or Pilbara did, or in North America, the likes of Buritica, which effectively issue, stuff that compounds 15, 16% return, which can go in earlier and effectively supplements equity liquidity. And then we see, or at least we've seen, some of the companies that have done that, and if they've been smart, that then perhaps a year in or 2 years in, they refinance with senior debt and perhaps a supplemental equity issuance.
Isn't that quite a risky approach, though? If and we have seen some companies get into a bit of a debt trap.
No, and I think that's correct, right? And I think, would it have my appetite to do that? No, but obviously, for some commodities, there is. It sometimes makes sense to be the first mover in the market and to get your project built. And once it's built, it kind of eats away at supplemental demand from others. And I think some people take the view that this is the strategy that they want to go, and they want to pay the return to do that.
So if it's a super hot commodity, the prices are roaring at the moment, you think, I've got to get this project built, get selling this product while the price is so high, I'll take the risk on the slightly more expensive debt and hopefully refinance down the track.
Yeah, I think that's the fear. And I think secondly, let's be honest, equity markets for juniors have been terrible for the last 18 months. I think Australia has been a bit of an exception in terms of the gold space. But unless you have a lithium story to sell or a battery mineral story to sell, I think it's very difficult at the moment to actually issue meaningful amounts of liquidity. And I think that's where a lot of these kind of stream solutions or the Orions and Red Kites and some of the Norwegian issued bonds effectively eat and supply liquidity to those, not because the senior debt isn't there, but because in essence the equity isn't there.
Well, we certainly see all those guys at our conferences being very active meeting takers. So obviously there's a gap to fill at the moment. But Adolfo, how about Career Development Bank? What is your take on sort of some of these new commodities? Not new commodities, but things like lithium and cobalt and those projects you'd finance, where there's a quite a large sort of processing element involved.
No, we haven't done any lithium or cobalt yet, but it's a commodity that we would be interested to look at and consider. So if ever we look at a project like this, then we would definitely need a very good due diligence package. We would be looking at all these kind of independent reports from the technical, from the market consultants, and see whether this is a kind of project that we'll be able to support. See if the technology is there already and it's been proven. So we'll be doing all the due diligence analysis, relying a lot of things from independent consultants. Basically, that's the way we'll tackle this.
And would that be something you'd look to do with an offtake partner in Korea, battery manufacturer, someone like that? Like
yeah, definitely.
Batteries?
If there's a Korean offtaker, some battery producers or the car automakers, then there'll be a strong interest coming from our bank and to see if we could support a project like this. But definitely, we would have to do our homework and see whether everything stacks up.
Fantastic. Let's talk a little bit about your criteria and how you pick a project. You must get a lot of people knocking on your door. What's the process?
Well, I guess first, definitely, we would check if at what stage the project is in. Is it still in the exploration stage, or do you have proven reserves already? I think we would want to see a project with proven reserves. Then second, we want to see strong sponsors that would know that how to manage a project at that scale with enough capital to support their equity. Then see if there's equity or demand for that particular commodity. I think those are some of the important factors we'll be taking into consideration. Of course, there's other factors, the construction risk. How are they going to operate, the O&M risk, if there's a currency risk in the project. And then all of this we'll try to assess and maybe put a kind of rating on the project. And if it's above a certain hurdle rate, then we can probably support a project like this.
To what extent are you looking at sort of ESG around the project as well, sort of their community and their environmental and all that sort of thing?
Yeah, definitely. We're an Equator Principal Bank, so we have to make sure that all the projects that we support are Equator Principal compliant. So basically, these are the kind of principles that follows the IFC or World Bank standards in terms of environmental and social impact.
So from first meeting with a company until giving them a loan, how long does that process usually take?
It depends, but basically from the time that they can give us a full due diligence package, right, and to get the credit approval, that will take about 4 to 6 weeks, assuming that everything is in proper order. But normally, for projects, this could take a year to 2 years, especially in Southeast Asia. Sometimes it takes longer because of all these regulatory issues, government approvals, negotiating with off-takers. But if everything's already in proper order, they can give us the full information memorandum, the feasibility study, and all the due diligence package. It will take about 4 to 6 weeks.
But even with all that due diligence done, sort of cost overruns seem to be an issue. How do you mitigate against that?
No, that's definitely a risk. And most of the time, we would require some kind of completion support coming from the sponsors, whether it's a completion guarantee or some additional equity or cost overrun, funding.
And Arno, your approach to the process, how does the process work at ING?
Well, I think it's in a way similar, but I think to kind of zoom out a bit, what we look for in projects is in essence quality, right? So we want to have, tier 1 or perhaps tier 2 assets. So, meaningful grade, decent reserve life, so that if for whatever reason you run into an issue during ramp up, that you're not meaningfully eating into your reserve life and have an issue thereafter. And we believe that helps us overcome the absence time to time of creditworthy guarantees for completion risk, because we believe that if the asset is a decent quality asset, there's always equity capital or sub-debt capital available that can supplement if for whatever reason a cost overrun is larger than you originally anticipate. And for all of you who write feasibility studies and are selling your project, the average cost overrun in the mining industry in the last 15 years has been 28%. And that's indiscriminate, whether you're a junior or a major, whether you're a BHP or company with a $50 million project, it's always there. And the initial estimate is always for 5 to 10%. And I think there have been a few exceptions the last 2 or 3 years, mainly because the contracting environment has been so incredibly favorable because a lot of the contractors had nothing to do. But we can already see, I was in Perth last week, we can hear from everyone that the contractor rates are already pushing up. Contractors are already trying to negotiate margin back in because the margin market's coming back. So I think for us, we look for quality. We like KDB, we try to assess that through due diligence. But in essence, also through our own awareness, we run a large team, so that means, we have a geologist, we have 2 geologists, 3 mining engineers, 2 metallurgical engineers who all work in our team. So we keep a fairly wide inventory of what's going on in the market, and we keep a decent view on what's happening, which companies we'd like to talk to, where we think the opportunities are.
And of all the companies you talk to, how many would you offer a loan to?
Well, the ones that we initiate conversations with, I think, have a very high conversion rate. I think the other way around, it's lower. I think probably 1 out of 3, if I say so.
Okay. And of the companies you've financed, how many have had a cost overrun?
No, so
has anyone come in on time and on budget?
No. So like I said, we analyzed the 100 projects that we had financed over the last 15 years, and that's proper project finance. I think it was 14 or 15 came in on time and budget. The rest of them didn't.
But as long as it's not too much, it's all good.
Well, like I say, I think a significant category fits in the, you issue a little bit of equity, or sometimes we provided some sub-debt, or we did something else, or we provided a small commodity hedge to see them through the day. But some of them were quite substantial. It's been a few years, but there have been meaningful cost overruns. I think, in essence, I think market precedent is to finance kind of with a 10 or 15% cost overrun of the initial total capital cost estimate. With a cost to complete mechanism, that means the equity goes in first. So, let's say you have $100 million to spend, you have $15 million of cost overrun funding. Now let's say $40 million of equity goes in, so that means that by the time that actually the 15 is more like 13% because the 15 refers to the 60 million that's left to spend. So there's a decent kind of cost overrun. And we take the view that by the time we draw down, we've got a good visibility on whether this thing is going to actually be delivered for 100 or it ends up being 130 or 115. So we can address it before it gets out of hand. But like I said, cost overruns I think are relatively common. They haven't been the last 2 years because of where the prices are. So when you find your banks, you need to have banks that know the sector so that they're not going to freak out when it happens, because it always happens. And secondly, don't treat your bankers like idiots. They know a cost overrun will happen. If you tell them that it's not going to happen, it just erodes your own credibility.
Have you ever done a study, though, of those 14 or 15 that you mentioned who came in on time and on budget? What were they doing differently?
Well, I think generally it seems that smaller projects and more conventional projects are easier. I think, conventional kind of CIL gold plant is much easier than, developing a high-pressure acid leaching project in Madagascar. So I think there's a gamut of risk and of opportunity. Competent management, definitely. But I think also a degree of luck, right? I mean, the contracting environment is good. The absence of strikes or civil incidents or suspensions.
Bad weather. I mean, this part of the world, obviously, Indonesia, it's quite a common thing for the, rain to fall for weeks on end and the thing to flood and suddenly you set back.
No, that's why we look at a number of things. We prefer to have the project to have a very good EPC contractor. Maybe the contract would be on a full turnkey, fixed price, date certain kind of contract. Then we'll be looking for completion guarantees. We would want to see a very good contingency in the project cost that would cover any cost overruns as well.
And also, I mean, mining companies, it's well known that transition from going from explorer to producer can be a tricky thing when the company might be founded and run by people who are maybe experts in finding things, but maybe not so expert in building things. What's your advice to companies when they make that transition to producer?
I think it's twofold. I think, first of all, the transition is important that you find the right management that can build it. But perhaps I think that's one thing that I think most people are aware of. I think the aspect that is more often overlooked is operational readiness. So the successful cases of successful ramp-up that we've seen are people that effectively a year before commercial ramp-up begins have their entire kind of management, mining engineer, their chief metallurgist ready to sit down with the EPC contractor and to manage, to make sure that they build the plant that they want, that they are ready, that they know what the maintenance looks like, that they know how everything works. Because we often find that projects kind of, once they get through the capital cost overrun, they start up, they go fine initially, and then they kind of crater, and then it takes them another 18 months to come back up. And I think that's purely operational readiness. So I think that's really an aspect that I think a lot of juniors don't fully appreciate.
Adolfo, any thoughts on that?
If you're an exploration company or a small company and you're going to the next stage of your project development, it might be a good idea to partner with a more experienced kind of company with huge capital and with experience and expertise to do this kind of big scale projects. And it's probably better if you're looking for funding from banks, banks, project finance lenders.
Let's talk about sort of the availability of financing, though, the pools of capital. How's it looking in terms of if miners want looking for project finance, and how much is available these days? And are you loosening the purse strings or tightening them?
Well, I think from a macro perspective, right? Look at the global capital markets. There's effectively limitless liquidity available, so it's all a matter of price and risk appetite. I think the commercial bank market, I think the largest mining transaction that was ever done was Roy Hill, which was $7.7 billion. So I don't think liquidity is an issue. Credit quality is. If I look at the competitive environment, I think in the US you effectively have 7 to 10 banks that take junior project development risk. I think it's about the same in Australia. The domestic banks kind of go in and out and decide what they want to do, but they're kind of seem to be back in. And I think in Europe it's a little bit fewer. I think it's 5 or 6. So I think projects that need senior debt, junior development projects that need senior debt up to the number of $300-400 million can purely go to the commercial bank markets. No issue. I think when you start pushing the number beyond that, I think it becomes a bit more challenging sometimes. And then it becomes a question of credit quality, asset quality. Can you find other sources of financing? Can you strategically procure equipment from locations to make sure you develop ECA cover? Can you sell your concentrate to Korea or Japan or Germany to create ECA cover again under the Untitled programs? That's ways to supplement and add to that liquidity that I think otherwise is just after a certain concentration cap. No matter how much I like a project, after a certain amount, and there is enough of a good thing.
Yeah, no, I agree. I mean, if you have a very good project, then liquidity I don't think will be an issue. I mentioned Roy Hill, where they were able to raise 7 billion, and then if you look at Mongolia, Oyu Tolgoi, which is a frontier country, we were able to raise $4.4 billion, and that's a combination of ECA and multilateral financing.
And how about the competition you're now seeing from some of these non-bank lenders? You mentioned earlier Orion, Red Kite, people like that. Is that a growing sector? People are seeing some success?
Well, I definitely think it offers companies an alternative if they want to fast-track their project. I'm not sure if I would ever do a deal like that, because I think the optionality that is available in those contracts is significant, so significant that I think it eats away every equity return from that equity shareholders will ever get. But there's a time and place for them. I think, especially in challenging jurisdictions, there is a time and place for them. We are about to sign or close the transaction for Fruta del Norte, the gold mine in Ecuador of Lundin Gold, where we're working together with Orion, where they've provided risk capital that otherwise would not be available because, again, there is too much of a good thing. I mean, Ecuador is not exactly the best zip code on earth. And I think they're raising $300 million from the bank market, and then they need additional liquidity, and raising $700 million of equity on Ecuador is also a bit of a challenge. So, there is places where there is a natural spot for them and where, you can negotiate appropriate outcomes, but go in with your eyes open.
It's horses for courses, as they say. Do we have any questions from our audience for our speakers here? Stick your hand up if you have a question. There's a question in the middle there.
How important do you consider hedging the price of the metal for a junior mining company in its early production stages?
So I've always run my business not as a means to sell a hedging business. I think there is a time and place for hedging, especially during construction when it concerns kind of cross-currency exposure. But I do think it is an appropriate risk mitigation strategy, especially in the initial stages of ramp-up. And I think we're seeing a growing acceptance again in the industry that hedging, not blanket hedging, but smart hedging, is an appropriate risk mitigation strategy. You know, we've seen companies effectively in Australia, because Aussie dollar gold prices are very high, as a way of delivering their project and ensuring that they don't run out of, or that they generate operating cash flow during their startup, that they hedge 20 or 30% of their gold production, just to increase or make sure that they have a certain break-even price when they're going through their ramp-up. So, yes, we look at it. You know, if the project has more price exposure than others, then it almost becomes a must. You know, if you have a tier 1 or a tier 2 project, you know, on the first half of the cost curve, I will not bother you with hedging. You know, I think we'll have the discussion to see where, you know, it is an appropriate risk mitigation strategy, but it's just a discussion.
Depends on your margin and the volatility of the commodity. Yeah, absolutely. Any thoughts on hedging?
Yeah, I mean, for banks, I think we would we don't want like unpredictable things, you know, market risk. But of course, you know, we could also look at market risk depending on the situation. But if the market risk is not acceptable, then we'll probably ask for some kind of hedging on the commodity price.
But do they get do these companies get a lot of pressure from their shareholders sometimes not to hedge, because they you know, investors can be quite optimistic sometimes and they think, well, you know, the gold price is going up or something, don't eat away at my upside?
Well, I think, you know, equity investors, or at least some of, you know, the BlackRocks and the guys that I've spoken to, accept that it is an appropriate risk mitigation strategy, as long as you don't give away the full house, right? And you know, I see it as a way to reduce risk, and I think equity investors are starting to see that as well. In fact, we have several very large listed kind of base metal producers that are actively using hedging strategies to fund some of their significant capex investments that they are going to do. Because perhaps during the last down cycle, which is only, what, 12 or 18 months ago, they realized that being at peak capex and at low commodity prices is not a nice place to be.
Absolutely. Any further questions? Question in the middle.
You know, you spoke about you know, projects with up to $300 of financing, where, you know, they should definitely go and speak to commercial banks. Is there a lower threshold as well, below which it kind of doesn't become worth your while, just given the, you know, the amount of effort you have to put in the diligence? And the extension of that question is that the zone where some of the smaller non-banking players kind of become more effective, you know, when it comes to senior secured space?
Definitely, right? I think, you know, senior debt for less than $75 million, I don't think makes sense. My personal opinion. I think some banks see it a bit differently. I think historically, if you look at the mining space, there were always, you know, the Investex and the Macquaries and the kind of more higher risk kind of junior mining finance shops that raised equity for the juniors, then put some of the debt in, then took it out and could control the risk because they could control the issuance and knew what was going on. And I think, indeed, you know, some of the streamers and some of the other ones are potential competition for that. You know, some of those guys are also coming back and reopening their appetite. You know, I think Investec is back. Macquarie is casually looking at it again. So, yeah.
I mean, for us, for any kind of PF transactions, we would have a minimum amount, because anything less would not be worthwhile our time. So, for example, for us, we like $20-25 million, and we would want to have another bank with us in that kind of transaction. So that basically around $40 to $50 million kind of of debt, basically.
And what's your top end?
Oh, we can go. Depends. Very good country. Sometimes with the ECA, we can go to 500 million. You know, sometimes higher. Depends, depending on the situation.
If it's a really good project, you'll find a way.
Yeah, if there's a very strong Korean angle as well, then, you know, there will be a very strong government support in that kind of projects for us.
Absolutely. Any more questions from the audience? There? Question at the back there.
Hi there. Just wondering where I came in a little bit late, so you might have covered this, but we're interested in coal development in East Africa, and I was wondering if that was. I know you said that there's finance around, but I imagine that's possibly not as attractive as other areas and other resources. I was just wondering what your thoughts on that were.
What type of coal is it?
It's pretty poor quality thermal coal, to be honest. Yeah.
Because Arno, you mentioned that ING.
Well, I think, you know, everyone can have their own professional opinion about it, but I think we're seeing, well, as far as I'm aware, all European banks have stopped financing thermal coal mines. The Australian banks seem to be heading in a similar direction. So I think it is a more limited space where I think capital is harder to come by. The American banks still can finance coal, but historically have never really provided risk capital or development funding for the industry as a whole. So I think that's definitely a segment where I think traders and perhaps the more higher risk yielding instruments are available, unfortunately, because I think others can no longer do it.
Does KDB finance thermal coal?
We have no policy against it, but there's going to be a lot of questions from our management on why we're doing this. It's just going to be more challenging for us to look at these kind of projects.
I mean, you raised the issue around traders maybe getting involved, doing some off-takes or something like that. Is that how's the environment in Singapore at the moment for the appetite for some of the trading houses to get involved with off-take financings?
There's one here, but I think reasonably strong. I think they're always there, right? I think they always offer prepayment solutions. They're always trying to put a deal together. So I think they're definitely there. I think there, especially in the thermal coal space, there's a big void to fill because of the absence of liquidity. Yeah. So.
Do you partner with the local sort of trading houses on deals?
Yeah, they're some of our biggest clients, so of course we do. Yeah, we have, we discuss all of these various setups and structures and projects on an ongoing basis.
Absolutely. Any further questions from the audience here? If not, we've covered quite a wide range of things there. It's been a very interesting discussion. Thank you very much for your participation. Can I have a round of applause for our speakers?